Hey everyone, George here. So if you're a contractor, builder, developer, and you own your own, shop, your own yard, or any rental properties even, if you haven't done so yet, one way to really unlock some non-cash outlay tax advantages, which are as good as it gets, without spending much money, you're getting some major tax deductions, is to do a cost segregation study. So I'm going to go over, who should do it. Usually like how these things work, how much it costs, and what it'll actually mean for your business. So let's get started. So when you buy a property, a lot of people don't know this if they haven't gone through it, but that $200,000, $300,000, $400,000 down payment that you put isn't a deduction in any way. So that is painful in the sense that you are out that much money and you don't get a straight deduction. Now, the other thing to consider is that if this property is a part of your business, if it's a residential property, you depreciate over 27 and a half years, everything outside the land doesn't depreciate. And if it's a commercial property, you depreciate it over 39 years. Now that 27 years and 40 years later, cash has very different value than it does today because of inflation. So sit and hope, to sit and get that depreciation over several decades is a very painful thing to do. It looks like little pellets on, your list of deductions every year, where it doesn't move the needle much. I mean, you paid all this money, and we all know that a lot of this stuff, depreciates way quicker than 27 and a half and 39 years. Lights go out, flooring needs to be changed, a kitchen needs a remodel, and this is all money that you have to put out the door. So how do we go about, accelerating your deductions? So there is what's called a cost segregation study, and this is an engineering/accounting report that is an IRS compliant report, and it'll help hold up in an audit and gets to accelerate your depreciation. Now, the real advantage to 2025 and going forward is that with the OBBB that passed here just several months ago, you can actually 100% bonus depreciate anything on the property that has a useful life of under 20 years. So outside of the, building itself, and when we refer to the building itself, we refer really everything exclusive of even the inside fixtures, furnitures, leasehold improvements, personal property, all that. Outside of the building and the land, everything else you can even bonus depreciate in 2025 or going forward. So for example, if you financed a big kitchen remodel, you can effectively take that entire amount as full 100% expensing in the current year. If the remodel was $150,000, you can expense that whole thing, even if you financed it over a period of, let's say, 5 years. I've seen cost segregation reports that, take up to 30% of the value of the entire property as, a deduction, they put it in the buckets of under 20-year life, one way or another, and take it, and we end up taking it as an expense up to 30% of the value of the property. So if we're talking about $900,000 property, for example, $270,000 of it becomes a straight deduction in 2025 or going forward due to the bonus depreciation rules. So let's go over who should consider, getting a cost segregation study done in 2025 going forward. If you built or bought a commercial property, if you renovated or improved real estate, if you own any sort of rentals, including short-term rentals, if you operate outside of your own building, warehouse, shop, whatever, or if you're planning a new build or acquisition in 2025 or going forward. Now, even if you bought the property years ago, you can still get a cost segregation done and get it looked back and get the tax advantages like in the current year going forward. So in the net, even though that down payment, that 20% down might not be tax deductible in and of itself, this is definitely one workaround. This is definitely a good tax strategy to have. Now, how much does a cost segregation report cost? I mean, we're currently in November 2025. I have seen these reports go out for a couple $1,000s. I've even heard of, I haven't used these services, but as low as $1,000. However, I do recommend getting a scope of work that includes the audit protection. And you do want it to hold up in the event of an audit. So to some extent, make sure that you actually review the scope of work carefully and make sure it seems like a reputable group. The whole point of this is that it makes your claim deductions against this fixed asset, this real property that you have, audit proof. Now, what would you expect to come of your cost segregation study? It would basically be a set of full engineering backed reports. It would have clear asset classifications by bucket. It would have your structural improvements, leaseholds, personal property, any machinery and equipment. All this would be broken down by category, and then buildings, the land. It needs to be under the IRS compliant tax codes, which you can look out for, make sure in the scope of work. I'm sure it's in there, but always double check, which would include RevProc 8756, Treasury Regulation 1.168, and possibly the Cost Segregation Audit Technique Guide. Now, how often do you need to get this done? You really just need to get it done once in the lifetime of the property. So I know a couple grand might seem annoying to have to deal with, but I would highly recommend ponying up that amount. And like I said, you could probably even get it done cheaper, and just make sure you're covered with audit protection and all the proper IRS guidance and RevProc, everything. Make sure to do a full, maybe get 3 quotes and do a full comparison of the scope of work provided by each. The audit protection is the biggest thing for sure. So you just need to do this once in the life of the property, and it accelerates your depreciation and gets you a nice deduction. I had a client who had a real estate purchase, and what we did had rent prepaid. Let's say the rent was about, let's call it $200,000. We had it prepaid 5 years at $40,000 per year. And then the cost segregation study gave us enough, property to depreciate, and we elected to defer it over a 5-year period. So the prepaid rent became deductible fully at one entity. So we got a $200,000 deduction there. And then as it was being included in income at the rental entity, we took the cost segregation depreciation amounts over that 5-year period. So effectively over time, that income was completely not just deferred, but permanently wiped out in a very legal and compliant manner. So if you have any questions, feel free to reach out, talk to a CPA, talk to somebody who's proficient in this area. And definitely, if you own real property that's included in your business, this is not something that you're going to want to miss out on. It's definitely something that you want to include in your armory of strategies. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.